Jeff, really appreciate you coming on. Obviously a tough day. Can you talk about the origins of this guidance, where it's rooted, and whether you yourself were surprised?
Well, thank you for having me on today. You know, we're coming off a really strong Q3 of nearly $1 billion of quarterly revenue, growing 32% year over year. And so we thought it was a really strong quarter, especially signing some big new customers, some big new deals. We talked about, an 8-figure software deal that we signed with a major Fortune 100 insurance company for Flex, our contact center product. Launching our newest software offering, Twilio Engage, with Discovery Education, being an amazing customer, an early adopter of that product. So coming off some great news from Q3, we did give a bit of a difficult guide. And when we look at it, Twilio has a usage-based revenue model. So when end users are using more of our customers' applications, well, we'll tend to make more revenue. And if they're using them less, then we will make less revenue. And that's not a dynamic of like, did we sign new customers or did we lose customers or any of that? It's just a matter of what's the economic activity going on out there with all those B2C companies that are out there in this digital revolution, serving customers through all the apps and all the applications that we use every day. And what we've seen is moderation in a few categories. Crypto is one where we've just seen less usage of those apps. And it kind of makes sense, right? We've also seen a bit of a weakness in retail and e-commerce or some other categories, but we've also seen strength, back to what you were just talking about, in financial services, where, when the market's very dynamic, people are using those services more because they're trying to navigate these difficult times. But on net, that did result in us giving a bit of a cautious guide to Q4 because we are seeing some changes in end user behavior.
Right. You think 35% is too harsh a judgment from the stock?
I don't comment on our stock price. Obviously, the market does what the market does. But, what I can say is, we've got a great business. We talked to investors yesterday about focusing on really just a few key areas where our company is laser focused. First of all is profitability. We again recommitted that we will be non-GAAP profitable in 2023. And then we added in our analyst day yesterday that we are going to seek 100 to 300 bips of bottom line improvement annually thereafter for the medium term. And so we laid out a plan for how we are going to not just become profitable, and we already took a fairly significant cost action to decrease our cost to enable us to achieve that profitability faster. And but we also laid out the plan to really focus our go-to-market resources on growing our software businesses. So our contact center business, our marketing automation business, our CDP business, and because those are higher gross margin products. And so we're really getting much more focused as a company to achieve profitability, to grow the software side of our business. And we've got a very clear plan on how we're going to do that.
Jeff, good morning. It's John Fort. Yes, the stock reaction is harsh. And I wonder how much more is to come in the sense of how much does Q4 matter? Right now, there's a big inventory overhang, talks of a lot of discounting during the season. And, we've heard from the likes of Qualcomm about a buildup in chips, materials in the supply chain that might not get cycled through. If your model is consumption-based, if that overhang continues after Q4, that could be rough on the overall economy. So what kinds of cost reductions are you prepared to make those targets? And it's painful, certainly, when we're talking about employees.
Well, look, there's only so far I think those consumption behavior changes go. By the way, consumption is a big part of our business, but it's not our entire business.